You think we're at the beginning of a 10% correction?
10% corrections do happen on average every 18 months. And what we're seeing is just horrible market breadth.
I think the weak breadth is a reaction to the strength in dollar and yields.
The market is at risk of a 10% correction in January. Breadth is fading, macro is misbehaving as a symptom of a less dovish Fed, higher rates, and a stronger dollar. This means less supportive financial conditions for already fragile industries, and earnings growth estimates have gotten worse.
I think the next 6 to 8 weeks could be rough. It's not going to be fun.
We've got weakness because of some insecurities building, general profit taking, and some sort of let's wait and see how 2025 is, given we just booked two 20% back-to-back years.
We're going to have some headwinds to deal with, and we may see some of those Mag 7 names give back a little bit. And I don't think the rotation will keep up enough to prevent us from having a correction back to the 200-day moving average, just above 5,500.
I think that there has been some concerns about macro, as you saw some events over the past few days. Pretty dramatic move in long-term yields.
I think the weak breadth is a reaction to the strength in dollar and yields. You're seeing it impact the small caps. You're seeing it impact the broad market the most, whereas the Mag 7 tends to be the least impacted by rising interest rates. We saw that in 2023 and part of 2024.
Long-term yields represent the cost of capital, borrowing, servicing debt, and the future cost of earnings growth. When yields rise too fast or to very restrictive levels, this can hurt the future earnings growth of rate-sensitive companies, triggering the market to reprice lower. Now looking at the dollar, which is breaking out, may be a little too strong. US goods are priced in dollars, which become more expensive, hurting our export GDP growth, which also trickles into earnings growth for those multinational companies. The US wants a strong dollar, but too strong is not always good for growth.
This is a secular bull market. My overall thesis has not changed, but during these bull markets, you do have normal corrections.
And this is the three-body problem, keeping the market hesitant, weak market breadth, rising rates, and a strengthening dollar. Now, when it comes to market breadth, let's use a visual to understand the weakness. Now, the market is still holding the uptrend, making higher highs and higher lows, but underneath the hood, the uptrend is weakening. The percent of stocks trading above the 200 daily moving average has fallen below 60%. And the last time we saw this level of decline, the S&P had a 10% correction that started in August and bottomed in October of 2023. We can see market breadth decline to the same levels we see today. The S&P pulled back, supported the trend, but as soon as rates began to reaccelerate, breaking the previous level, market breadth collapsed along with the overall index. And the market didn't bottom until rates peaked around 5%. But if we look a little deeper, we can see that rates were just tracking the bump up in CPI, inflation. And as soon as CPI confirmed the bump up was over, rates peaked, breadth returned, and the market recovered. But the next CPI report isn't until January 15th, which means the market has to wait for more visibility on inflation. Until then, the upward pressure of rates is likely to prolong the correction.
The hope for the bulls is that washout in breadth that we saw in December is an opportunity, and we can see breadth rebound. We're certainly seeing it today, but I think for that rally and the breadth broadening to have any sustainability, you really need to see rates and the dollar not only probably pause, but really pull back lower, and we just haven't seen any signs of that to this point.
Now let's move over to some of the more promising macroeconomic data to kick off 2025. The macro indicator that best reflects the business cycle is starting to wake up after being in recession for years.
We are seeing manufacturing recover. The ISM manufacturing posted one of the highest readings in almost 2.5 years. I mean, it's been below 50 basically for nearly 3 years.
If you look at the manufacturing cycle, it's been in a downturn over the past 2 years. And the reason why that matters so much for equities is because half of earnings for the S&P 500 is tied to the manufacturing cycle. It's been the longest downturn in history for manufacturing. And as that manufacturing cycle comes back, because the destocking cycle is over, the election overhang is removed, and I think the CapEx cycle is going to accelerate again. If that's the case, I think that's going to be a major boost for earnings for an average stock, and I think that's really going to be the driver of the market broadening out.
Manufacturing is the most capital-intensive sector of the economy. It is the biggest driver of economic activity and earnings growth. Once we get the ISM expanding above 50, that is a signal of a new bull market cycle.
If we're getting from here to 7,000 in less than 6 months, you're talking about, 35% annualized pace of gain. So how do we get there?
Just because the calendar year changed doesn't mean that the strength that we saw throughout 2024 suddenly has evaporated. There are tailwinds building because the Fed is dovish, even if they're making fewer cuts.
Now remember, the Fed is data dependent, so the employment report on Friday will give us some more visibility to how the Fed may shift their cutting speed going into the next meeting. Weaker employment forces the Fed to pull forward cuts. That's only going to accelerate the manufacturing cycle and push rates lower at the same time. This would be a bull market reset, causing initial concern, followed by more liquidity, lower rates, and more confidence in these cyclical sectors.
I think the labor market could be softening in a way, because whether you look at link-up data or the ISM employment, to tell us that the Fed now has to be focused back on supporting the economy. So I think this month could be quite decisive in the sense that we've got weakness because of some insecurities building, but I think it's, the same tailwinds are in place. I mean, I think it's still a buy the dip kind of market.
Now, whether or not the market corrects 10% or not, we can be confident that a lower inflation print should cap rates and broaden the rally.
I think the big term, the big picture, this will be an opportunity.
The sectors that we like are more cyclically oriented sectors, such as financials, consumer discretionary, materials, real estate, and utilities is kind of like our hedge against things going wrong. And I think the biggest driver of that rotation, like I said, is going to be driven by earnings breadth broadening out. I think the driver of that is going to be manufacturing cycle coming back.
Financial conditions should ease this year. Easing financial conditions does allow some cyclicals to post better earnings growth, like financials and regional banks. Industrials and small caps should be a case for broadening of the markets this year. And then I think in terms of risk appetite, still one of the good measures to look at how risk appetite is to look at something like Bitcoin, and at 97,000, it's still telling us that, this is still a risk on market.